Hello. I haven't posted a video in a couple months, and I've been busy, but also I didn't want to report back until I had something that I felt like I wanted to report. I had previously been trading the price slope method on the Spider Sector ETFs, and I had some good results. So after I got out of trading small caps, I thought I would try the method again, and I've been trading it for about 2 months. During that 2 months, we've had one of the sharpest recoveries from a bear market low that I've seen in recent times. Though as of today, September 29th, 2022, stocks are on a downtrend again. So overall during this period, the SPY was up by 7.5%, while IWM, the small cap index, was up 11%. So unfortunately, my price slope portfolio is only up 1.3%, which is better than being down, but lagging the indices greatly. Though it's pretty obvious and interesting to note that the day-to-day volatility of the price slope portfolio is vastly lower than either SPY or ETF. I also show my cash position in green, and you can see that I've been as high as about 80% cash. And at one point, I was actually negative, which means I was using about $7,000 worth of margin debt. This recent bear market rally has been pretty tough for the price slope method. The way it's played out, we have week-long periods of flat returns and then a small correction. That small correction then pushes me most into cash, and then the next day after the small correction, we get a huge spike up. But I'm mostly in cash, so I miss out. But then most of that little rally actually happens on the first day. So by the time I chase back into the market, we're flat again. So I'm having some trouble kind of following the uptrend, which has been kind of cyclical and spotty. But during the pullback during the last 2 weeks, the price slope portfolio is actually flat, while SPY and IWM are both down between 5 and 10% each. So in addition to reduced volatility, it seems like the price slope method is providing excellent protection against downturns. So what am I trading? In addition to the 11 Spider Sector ETFs, I'm trading FXI, which is Chinese large caps, EEM, which is emerging markets, TLT, which is a 20+ year maturity US Treasury ETF, gold, USO, which is crude oil, DBC, which stands for Diversified Basket of Commodities, and BITO, which is the ProShares Bitcoin ETF. So one of my problems in the last month has been the drop in oil prices. My portfolio is pretty heavily weighted to oil. So in addition to USO, which is crude oil, I actually hold XLE, which is the energy sector ETF, and I also hold a good bit of oil indirectly through DBC. So maybe I'll get out of USO and just let DBC handle my oil positioning. So how do I trade the price slope method? I've really streamlined and simplified the approach. I'm 100% using Google Sheets. I make a 3-day prediction of price slope. This 3-day number is a value that I obtained through some back testing. So specifically in Google Sheets, what am I doing? So we'll take a look at GLD, for example. So if I want to compute today's price slope, I simply run the linest function, which fits a straight line to the past 3 days of price data. It's the same function in Excel, though the arguments might be slightly different. So if the slope of that best fit line is positive, it's a buy or hold signal. Conversely, if the price slope is negative, it's a sell signal. So to use price slope as a predictor, I need to use today's closing price to change my positions for tomorrow. But there's a problem. All the back tests assume that I have today's closing price, and but then I have to wait tomorrow. But I can't trade tomorrow immediately. I have to wait until tomorrow to trade, and the stock may gap up or down. In this market especially, most of the gains may come during the gap up. So what I do is wait about an hour before closing, and I treat the current price, today's current price, as the closing price. So then I can adjust my positions for tomorrow and catch the gap up or avoid the gap down. So in this case, I'm currently holding 13 shares of TLT, but I got a sell signal, so I would sell 12 of those shares. I always hold one share of each security, kind of for convenience. So there's no reason why you couldn't wait until tomorrow to make the trade. But for my approach to be consistent with my back test, I need to use today's current price as a proxy for the closing price. So a key tenet of trend following is add to your winners and cut your losers. But how specifically am I doing that? I hold one share of each security at all times. If I get a buy signal, then I would enter into a $1,500 position. So recall that my portfolio is 30,000 plus or minus. So this is 5% of the portfolio. I'm trading 18 stocks. So if I had $1,500 in all 18, I would have $27,000 invested, or 90% stocks, 10% cash. If I'm holding a $1,500 position and it increases by 3% to $1,550, I double the position to $3,100 and keep doubling every 3% more that it rises. So now how do I cut my losers? If I'm holding a $3,000 position and I get a sell signal, then I reduce that position back down to $1,500. If I'm holding a $1,500 position and I get another sell signal, I would then reduce that position to one share. So is this an optimal way to trade? I don't know, but it decisively moves you up and down as you would want a trend following strategy to do. One mistake you can make is you catch on to a trend up, but you don't decisively enough move in the up direction. Or conversely, if it starts going down fast, you want to get out pretty fast, but not jump for a one-day drop. Take this with a grain of salt, because right now I'm getting whipped by the index, but this is what I'm doing. So anyway, I think I would like to report back. We seem to be at the present day kind of in the middle of another downtrend. We'll see if we kind of bottom out before we start making lower lows. I suspect we will. I suspect we may be back on a stable or bull market trend, but until we bottom out, we won't know. So I would like to report back once we get kind of a full up and down cycle to kind of see where we end up with the price slope method. We know that the price slope method does well when stocks are falling, but it seems to be lagging the indices when stocks are going up quickly. So anyway, if you have comments or questions, just post them as a comment below, and we'll talk to you probably in a couple weeks. Bye.